we're staying on top of one of the biggest mega trends on the planet, which is nuclear energy. Nuclear energy is eating the world. The biggest countries, the biggest companies, the richest people on the planet are all investing in it. The writing is on the wall. That's where all the money is going. It's needed for artificial intelligence. It's needed for space travel. It's needed for everything. And we're still in the very early stages of it. And if nuclear is needed for everything, then uranium is needed for everything. So that's why we're staying on top of the fuel that's going to power the world. And so obviously when you're looking at a commodity like uranium, what matters most is the supply-demand fundamentals. And so why is 2024 coming to an end so massive? Because according to UxC, which are uranium researchers, these are the secondary commercial inventories of all the nuclear plants that are going to need to buy uranium. So if you're wondering why the spot price of uranium can go down, even though we've been in a multi-decade supply crunch, it's because commercial inventories have been high, right? So the nuclear plants that are the primary buyers of uranium have had plenty of commercial inventories up until 2024, and those are expected to fall off a cliff in 2025. And so that's why 2025 is so potentially massive, because it's the year when uranium supply availability hits a brick wall and the rubber meets the road as nuclear utilities scramble to stack uranium. Practically the only source of uranium for these utilities is from the miners. And here's a look at where we've been in terms of global uranium production for miners in blue, and in orange, world uranium demand. So since literally 1993, we've been in a supply deficit. There hasn't been enough produced to meet demand because utilities have been able to chew through their massive commercial stockpiles. Well, those commercial stockpiles are going away, and so these nuclear utilities are going to have to rely on increasingly scarce uranium production, which hasn't been enough to meet demand since 1993. So again, the rubber meets the road in 2025, but don't take my word for it. Let's look at what some of the biggest Wall Street firms on the planet, which have millions of dollars to pour into their research for their clients. This is what Morgan Stanley is saying. It's their top bullish conviction play of all commodities. Silver, lithium, copper, and platinum are also in that tier. But here's the case for uranium. Our commodity team placed uranium as their top pick due to the improving risk reward. Supply is likely to disappoint as cuts start to come through, and contracting activity should pick up in 2025, leaving a deficit for the year. Unbelievably massive for early stage investors in uranium miners. Goldman Sachs has sent uranium investors a Christmas gift with public release of its report to clients on how AI and data centers' global power surge will drive a significant rise in nuclear energy. Here's the challenge: confidence in enriched uranium supply. Goldman Sachs's energy equity research team highlighted the three processes needed to supply nuclear plant feedstock: uranium production, uranium conversion, uranium enrichment. Each is not done in the same place, so it could also require transportation. China, Russia, Kazakhstan together represent about 46% of uranium supply, 44% of uranium conversion capacity, and 59% of uranium enrichment capacity. We note that the enrichment requirements for SMRs, brand new technology, nuclear small modular reactors, are expected by IAEA to be 5% to 20% versus 3 to 5% for large-scale reactors. We expect greater clarity on rules and confidence surrounding uranium sourcing will be key towards moving forward with a meaningful ramp-up in nuclear generation capacity in the US and Europe. Other challenges include permitting, nuclear waste, siting/storage, plant security, and skilled labor. So essentially what they're saying is the demand for nuclear and the demand for uranium are both expected to skyrocket going forward. What about RBC capital markets? Nuclear revival is going to need a lot more uranium. Uranium prices are set to remain elevated through next decade. Higher incentive prices are needed. We forecast $90 per pound average uranium prices from 2025 to 2028. And we see potential upside from supply risk, especially for Western-aligned utilities, as geopolitical tensions create friction in the global nuclear supply chain and new supply takes time to ramp up. Here's an example of friction in supply chains. It seems Atlantic Project 2 left St. Petersburg without enriched uranium. Another shipment of Russian enriched uranium has failed to depart St. Petersburg this week. If people only understood a 30-year supply chain has been disrupted and won't be back, the magnitude will be felt shortly. That is exactly what Goldman Sachs is talking about. What about BMO Group? December 16, 2024, reflecting on a uranium supply deficit. We reviewed our supply side uranium forecasts alongside our Q1 2025 commodity preview with slightly lower near-term production. We continue to expect the market to be in a modest deficit out to 2029, supporting higher uranium prices. And so that's a look at 2025. What happened this week? EU moving to develop infrastructure for nuclear energy expansion. So they're expanding their infrastructure, which should expand nuclear power generation, which should expand uranium demand. Westinghouse signs a 20 billion Canadian dollar agreement for nuclear projects in Canada. Cameco owns something like a 50% stake in Westinghouse. Very good for Cameco. And so that's why uranium prices lagged in 2024 and why they're expected not to lag in 2025.